Hi, everybody, and welcome to the European VC podcast. I am David, and I am thrilled to be here on a special one-on-one fireside chat with the master of chaos, Fred Destin, founding partner of Stride. You may remember Fred from our past episodes, but if you do not or haven't listened to that yet, Stride is currently investing out of Fund 2 with a total of 220 million British pounds in AUM, with an established portfolio of approximately 25 companies per fund and recent investments including Triver, Conceivable Life, TechWolf, and Hoffy, and some notable investments counting Zoopla, PillPack, Superhuman, Linktree, Deliveroo, Secret Escapes, Dailymotion, and Integral Ad Science. If you're listening in and love our show, you know what to do. Drop us a review, follow the pod, and subscribe at edu.vc.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Fred, we were meant to do this fireside chat in Dubai for the Expand North Star conference. Unfortunately, the stars didn't align and we couldn't make that happen, which was a shame. I was personally sad about that. But we decided, well, we can't let this opportunity pass by. And so we thought we would do this on the pod instead. Fred, welcome to the show. How are you today?
Thank you so much. I'm great and I'm glad to be back.
So for those that don't know, Expand North Star, and it was my first time in the region and in Dubai specifically, is a very interesting conference, and they had investors from all around the globe. So we had Europe represented, we had US, we had Asia, we had, it was really interesting to see all these different viewpoints. And so the whole concept of this fireside chat with Fred was kind of give a view, starting off with giving a view on the market from where we stand and from specifically Fred and Stride stand. So Fred, would you give us a quick rundown of where you see the market today? And let's not shy away from, giving kind of a macro view as well to people that might not be living and breathing venture like we are every single day.
For sure. So look, I think the theme of the day is that we're processing the overhang. So, I've been in ventures since 99. And I think the crisis we're in right now is probably comparable to 2002 because of its depth and its length. And, if you've lived through the 2008 crisis, that was a liquidity crisis, but, we had the benefit in tech that we recovered within 6 months. The iPhone came out and the whole mobile platform plays started delivering value. And so we really didn't feel it that much. It was tough in the moment, but it was short. Whereas this one is complex and all-encompassing. And so right now, I think if you're a 2016 vintage fund and you had, 5 years to bring companies to any form of liquidity window, you're probably doing okay in the sense that you had a chance to exit some capital to show some decent DPI numbers. But, we come out of a stage where we had these incredibly high graduation rates, 80% plus, compared to market standard might be 50. We had fast markups between rounds. We had blitz scaling strategies based on infinite capital access. And, by the time you get towards the end of that cycle, as I said, either you'd hit the liquidity window and good for you. You basically pass the bag on to someone else, which we can discuss whether that's right or wrong. Or you get risky mega rounds done for your companies. And so if you look at maybe the 17, 18, 19 vintages, they're more in that category, which is they get a lot of companies that got funded and extremely high valuations, raising 50 to 200. And, at sky high values and with huge liquidation preferences. So now we're looking back at that and looking at, I think, 3 primary things that are happening for existing funds. So one is, call them re-ratings or markdowns that are in line with public companies. So say if you look at the Bessemer Cloud Index, it came down 50 to 60%. And so you're going to naturally find that some of your more growthy companies are getting re-rated. And it's painful from a return standpoint, but it's okay because these companies are healthy. They should drive value over time. So it's going to reduce your return profile, but your asset is still performing. You then have a second category, which is either recaps or cram downs. That's when the liquidation preferences come down. The growth funds will use that either in recovery scenarios, but also will use them offensively to drive their ownerships up. And that is the kind of scenario where it's almost impossible for seed funds to recover from that. We just don't have the firepower to follow in these recaps. And then the third category are segments where you have full market dislocation. So certain segments are just completely shut down for new funding. You can think about online groceries, for example, as one of those where just nobody wants to touch the segment. Insurance, maybe if you look at Lemonade and what happened with Luco, would be in a similar category, but there's just no capital and people are so burnt that they don't want to come in. So we're looking at this stock of companies inside seed funds, for example, and I think one of the issues we're faced with right now, or there are two of them on the LP side. Number one is the LPs have no confidence that the GPs are showing the true value of their portfolio. I've heard this now 20 or 30 times, that managers, instead of marking their portfolios down or at least being transparent about the state of the assets, are sort of trying to play a game of let me delay the markdowns for as long as I can. And the LPs are really pissed off because they don't know what to believe in terms of what they're being shown. We had a case for one of our companies where we took it down 50% early because we could kind of see the writing on the wall. And then a number of my LPs called me and said, hey, I'm seeing these other funds that have marked this position, either at cost or maybe they took a 25% markdown. And we're trying to make sense of what's going on, which, puts us in a difficult position because we're not trying to hamstring our co-investors. But, it's an example of, I think, very differing views inside the GPs as to where these assets should be. The second thing that's a little bit complicated is that a number of LPs either forgot or have had no experience that this is a cyclical market. So the experienced LPs, the harbor vests of this world who are used to investing through fund cycles, know that from time to time you're going to have a tough vintage and you kind of have to go look through that for alpha. Whereas somewhat less experienced LPs are at the moment screaming and going, hey, you promised me money back. And now, your portfolio took a bunch of punches in the face and where's the cash? And so you're seeing people asking for DPI on quite recent vintages, to even 2018, 2020, and going, where's the DPI? And the answer is, well, you can't generate DPI that fast. And now you have this secondary craze, which is coming up, which is, look, the time to do secondaries was 2021. And now it's all the rage to talk about GPs need to learn how to generate liquidity. And the worst time in the world to sell your portfolio assets is, late 2023. And so, now we're again looking back in the rearview mirror, trying to optimize performance by doing exactly the wrong thing. Now, don't get me wrong. In some cases, you have to generate liquidity. So this is a must, not a nice to have. But I think we're seeing counter-cyclical strategies being deployed, which I think is just not the way to go. You just have to be patient, put your head down, focus on the portfolio, drive value one company at a time.
I think there you're hinting towards your view, and which I would share, right? It feels like it's a stark period, but as you said, it's part of the cycles, right? And experienced people know that and recognize that. I'd love to do like a side note here and ask you, because you painted a very, in my view at least, clear scenario what this means for fund performance, mostly for seed funds, seed VCs or seed GPs. What does this mean for founders these days? What do you think the real impact will be? Do you think we will see actually some negative outcomes of the cycle right now towards founders and entrepreneurship?
I don't know how to answer that question generically. What I would say is there is a lot more education and acceptance of the fact that founders need to be motivated going forward, or at least the management teams that are running the companies that may or may not be the founders. Hopefully it is the founders. And that, investors fully understand the need for carve-outs on lower value exits, re-incentive of the management team with cleaned up cap tables. And so my current experience is that people are a lot more mature about understanding that, if you don't put a few $1 million worth of exit value on the table for a founder, which is valuable years of their life they're spending trying to build value, that there's a lot more acceptance for that. The flip side of that is it's the oldest game in the book for an incoming investor to go ally themselves with the founders with their cram down and we re-incentivize. Actually, I think that's healthy because there's no way around the reality of what it takes to incentivize people and build a company. But, I think we're seeing quite a healthy response, at least in my limited, in the viewpoint I have on the market, a healthy response to that.
What you described there are somewhat, let's put it, they're not simple deal dynamics. Let me put it like that, if I will. And with a period where we had, a lot of new, both whether that's new funds, whether that's new practitioners in the VC industry. And here I'm really focusing in Europe right now. Do you think, and it's a bit of a philosophical and provocative question, but do you think our stock of VCs, seed stage, early stage VCs, are ready to deal with these complex dynamics happening in their portfolios in the market the way it is today?
Let me answer the question indirectly. Whether or not you are ready to deal with these dynamics, the reality is these situations are unlikely to be situations when you drive a lot of value. So I think that it's important to fight for every dollar, but as we know, the 2, 3, 4, if you're lucky, best companies are going to drive 90% of your returns. And so I don't know that as a seed investor, your ability to deal with complex deal dynamics is necessarily going to save your ass. I think your fundamental ability to pick category defining companies, etc., is what's going to save your ass. And so, rightly so, I think the LPs are very focused on what's driving value in the portfolio. And for ourselves, this is where it gets tough because you think, okay, I want to keep as many shots on goal as possible. I want to keep as much optionality in the portfolio as possible. But the reality is, in markets that are this brutal, a lot of these companies are shot. Like they may be shot because your return profile on them is shot. So in other words, the capital structure is such that you're unlikely to recover much of anything, or that the businesses themselves are impaired. And so I think it's important for the GPs to just take a somewhat dispassionate look at this stuff. And this is where you move into your portfolio, you put your portfolio management hat on. And, in my experience, you can have very honest conversations with founders. They take it quite well, which is to say, hey, look, I think the strategy is complicated. I think the company's future is impaired. We don't know what to do. And we're going to go focus our energy elsewhere. And, if you ever need a heart-to-heart conversation about your strategy or what to do with the business, I'm here. But, we're going to go focus our energy on the things that actually drive value. And I think founders get that. I think there's nothing worse than this kind of benign neglect that happens where founders just get ignored or left aside. You might as well just have the honest, direct, truthful interaction with them. And they get it. I mean, they understand our business. They're not stupid. And at least they're getting a true answer, or a true representation of where you're at.
That clarity, yeah, of course. So I think if we were doing this in the room that we had planned to do initially, there were some less, let's call them less experienced LPs in venture, so that they're new to venture, they're looking at the asset class now. I think it's fair to say that they might be thinking, listening to this, well, maybe I'm just gonna focus on like more growth stage funds and like not really, risk the pre-seed seed stage. I know that's not your view, so I'd love to ask you, how do you balance things off now? Because it feels a bit stark the way we've spoken about it so far.
So as an LP, you both have risk intolerance, and especially family offices just don't like to lose their money. And then you have, depending on your strategy, you really theoretically invest in venture for alpha. So there is a middle of the road way of thinking about this, which is to say, I'm just going to give my money to a large scale fund because that feels safe because they're big. The problem with that strategy is the large scale funds that are really exceptional, you probably cannot get access to. Index, Excel, General Catalyst. I mean, good luck. They're oversubscribed. They've always been oversubscribed. These are not managers that it's really easy to get into, even if you spend years building a relationship. I know, because I used to be at Excel, and getting a new LP in effectively requires an existing LP to drop out for whatever reason, or there's some small rebalancing, but it's really tough to get access. So then you're potentially left with managers that are middle of the road, where you're really not getting paid for the illiquidity premium that you're getting. And let's remember that the only thing that matters is getting into some form of top quartile performance. So your job as an LP is really to go assess on what dimensions a manager is going to generate top quartile and whether that story is credible. And we know that individual GP performance persists over time, but fund performance, with a few exceptions, does not persist either. So you can't really rely on history. And at the moment, when people are nervous or anxious, they over-index on existing numbers, history, etc., as a sign of safety. But the numbers historically tells you that may not work, or at least it's not very predictive. So I think the flight to safety in venture is a dangerous way to think. You actually, if you look at early stage portfolios, for example, they're not that easy to lose money on. It's interesting because there's kind of a misconception that at the individual company level, these bets are highly risky. So you will have LPs to say, 30% of your portfolio went bust, you're doing a bad job. Whereas in reality, if you're taking enough risk at an individual company level, you're expecting your loss ratio to be relatively high. But at a portfolio level, if the portfolios are built with discipline, you're unlikely to lose money. You could have lackluster returns, but to really lose money in venture if you're disciplined, unless again you get a terrible down cycle. But in a normal quote unquote market environment, it's not that easy to be losing money for your investors. It takes a special kind of skill, I think.
I can't remember, and I apologize for that, but I can't remember neither the guest nor the data source, but we had a guest recently sharing like a counterintuitive learning they had when they started in venture and they quoted some kind of data source that I can't remember. It was like the portfolios with biggest write-offs or highest levels of write-off also tend to have higher returns or potential for returns, which is very much what you're saying, right? It's not that you have 30%, 40, 50% of the companies going bust within the first 3, 4 to 5 years that you're not making money.
Yeah, exactly. Mapping or stack ranking funds based on their loss ratio is completely irrelevant. And if you're taking big enough bets, your loss ratio should be higher than if you're investing in relatively safe, say, SaaS analytics companies where, you're not going to drop that many balls, but the likelihood that you generate north of 2x net is pretty low, right? Because you've just compressed your risk profile.
So we're kind of we're touching on this lightly, like portfolio, different strategies. I'd love to ask you, and here I'm asking you, Fred, investor, not you, Fred from Stride. How do you think about the different venture strategies that one can employ and should employ? And maybe I'll ask a pre-question to that question is, can you believe that it's possible to time the market? General opinion tells us no. But as you think of your strategy as an investor, that's definitely something that comes into play.
Sure. So let's talk about venture strategies first. I think the purest form of venture ends up and remains a founder entering into partnership with a partner somewhere and they collectively deciding they're going to go build a great business. That at the end of the day, whatever we say about venture being shit or great or whatever, there is something quite pure about that, which is I believe in you as a founder and together we're going to go build something wonderful. In that model, I think that model is very hard to scale because it's highly dependent on the quality of the GPs and you need this kind of multifaceted skill set. This is where you'll find Benchmark, USV, etc., which are very much the role models for how I try to work, which is this boutique, one-on-one, engage approach, and where you make no apologies and you say, you know what, I am your partner in building this company. And that is the purest model. And then the problem with that is there's too many venture capitalists, and I'm not trying to generalize, but there are too many venture capitalists who don't have a view about the world that is particularly original, who don't know how to engage with founders, et cetera, which is why venture gets a bad rap, because you get a nondescript person on your board who's sort of a money manager and has no particular view about your company, the world, you as a founder, et cetera, and just, and it's a sort of a pretty mediocre experience. But done well, it's beautiful. Then you look at venture strategies that I think are differentiated and work well. And I'm just going to throw a few examples. I mean, the canonical example of ghost in the machine would be YC, right? Let me build a network of experienced founders and operators. Then I build a selection method, and then I let the network do its work. I almost don't need to be there in terms of selection. And I've created such a brand and such a community around myself that, it kind of becomes a self-fulfilling center of excellence. You could argue in Europe that Seed Camp is similar. You probably have 500-600 companies in portfolio. The network itself feeds, input, insights, and community with the founders. And, that's quite nice. They live at pre-seed. They can write tons of checks, highly diversified. You kind of get what the value prop is very clearly. I really like my former partner, Harry, I think has built something similar where he can't necessarily be the lead investor because of the way he operates, but what he's selling is very clear. You get media exposure on the front end, massive thought leadership machine, and then you get his network or the network of his network with the vertical funds he's doing, but that's a pure network asset. In other words, don't ask me to do any work with you. I'm not going to sit down for a half a day and go through a strategy, but you want access to Collison or you want access to anybody, I can provide that to you in under 48 hours. I mean, it's a very clean value prop. So I think these strategies, so that's more of a follower strategy. You're going to work, you're going to follow the tier ones into the deals that they do. But I mean, it's pretty beautiful, and I think it's pretty clean. I think the strong thematic approaches are powerful, provided you get some kind of virtuous circle. So Visionaries in Berlin, I think is doing a great job because their LPs are industrial families. They're focused on B2B SAS. They're talking about digitization of existing industries. The investment strategy is not that novel, but the ecosystem they built is powerful, right? So that's very consistent and coherent, and I think that's great. I also like people like 50 Years on the West Coast, and because they're like, hey, we're going to precede people solving humanity's big problems, and let's build an ecosystem of visionaries around that. Again, with a very clear value prop, high velocity investing. So these are thematic examples that I like. And then you go into the operational support VCs. Now, I think most platform services are pretty average because you know why? Because they're hard to do well. You have to put real resources and intent behind it. But if you look at Insight, for example, I've the example of two companies I worked with Insight. So one is Recorded Future, and the other one is Sedna here in Europe. Insight has two portfolios. There is the tactical investment portfolio, so they'll put 30 million into a company, minority ownership, and then they have the more strategic portfolio. So they double down in company, and then they start deploying these operational support teams. I think they're 300 people strong. And I think that the people in that organization are world-class at sales, organization design, and leadership, like whatever segment you want to choose. And so they're going to roll out these incredibly experienced operators into your company and really help you design playbooks and operationalize better the way you work. I mean, I have to say, having seen this in action, it is really powerful, done well, and it's quite transformational to companies that need to move from my stage to proper scaling, right? This kind of 30 to 500 million in revenues, which, to be honest, I know about, but I get so bored by it that, for me as a VC, if I'm on the board and we're now talking about scaling the sales force from 20 to 100 and sales incentive programs, etc., I'm starting to phase out completely. So great partners, and I think very powerful models. And if you have to compete with Insight head to head, and they start telling you what the playbook's going to be, what benchmarking they can do pre-investment, and how they're going to help you. I mean, they're really a compelling investor and definitely one of my go-tos. So there's as many venture strategies almost as there are funds, but I think there's some canonical examples like that. And the question for the GPs and for LPs is like, are you playing in your natural underwriting territory? Are you playing the game you're best at? I love deep work on product, strategy, people, branding, narrative. So does Gabby. And so we are quite naturally suited at the boutique model. And in fact, most of our work happens outside the board meeting. Like we will do 3-hour workshops or full day workshops where we go deep dive on a topic. And I have no problem saying that we do move the needle, not with all our companies, but with some of our companies. I think the work we do helps our founders move the needle. So there's this notion of VC value add, which is the most overused term on the planet. But if you look at where people are within their zone of excellence or their zone of genius or the zone of competence, I think they do actually help. And I think founders will say, hey, if you speak to the PillPack founders, they'll say, hey, there are a few moments, not all the time, but there are a few moments in the company's life where, we shifted our strategy or we moved the needle, our ambition or something that helped us execute better. So I think I live for these moments, which is when is the insertion point where you have something meaningful to say or to contribute. And the rest of the time, just let founders run their shit.
I like that a lot. From an LP perspective here, and it's always tough to speak from that perspective because the last thing we want to do is to be giving out advice or whatever, right? But from your worldview or viewpoint, do you see trade-offs between, because there's different models and there's different portfolio models as well, right? And they coexist, right? So it's like a diagram of sorts, right? In the sense that you can have very different models that lead to concentrated portfolios, or you can have very different models leading to very diversified and wide portfolios. And so from an LP perspective, specifically on this topic of portfolio, I'd love to ask you, what are your views on the trade-offs? And the reason I ask is because I myself, I've done a couple of angel investments into funds, and I have these very early stage incubator like huge portfolios, right? But also the very kind of synthetic bio focused fund, like super nerdy, super geeky, like very much doing less bets, much more deep work in picking and supporting and selecting, etc. And I think there's this kind of opinion in the market that everything that has a diversified portfolio is spray and pray, which I don't really agree with. And I'd love to hear your thoughts on the trade-offs between these two archetypes. Let's put it like that.
Venture math, without a doubt, supports what you might call as a spray and pray. So actually, if you're evidence-based, there is no question that more diversification tends to play well in venture land. So theoretically, it depends a little bit on the variance you want about potential outcomes and the certainty of where your multiple is going to be.
And that's where the geeks start geeking out on doing the Monte Carlo simulations. But yeah.
Exactly. So based on historical data, you actually continue to benefit from diversification almost infinitely, which is unusual and is different from other financial instruments. So you could go to 1,000 companies, you keep driving your expected return up, which is unusual, but of course you reduce the variance of the outcome.
Yeah.
So if you want to do I forget what the number is, 2.3x net, you invest in 1,000 companies. And maybe the optimal number is somewhere around 150. So if you look purely at venture math, people who knock spray and pray don't understand the nature of fat tail returns, in the kind of world we live in. However, that's not the whole story, because you also have you need a value prop to founders that makes sense, because otherwise you're going to end up in a very adverse selection phenomena. Or you're going to end up, a lot of the large-scale incubators where I'm concerned is they engineer companies out of nothing with people who aren't naturally founders, who haven't spent the hard yards finding the idea that's actually worth backing. So even though you're not going to find the comfort in numbers, if you're kind of engineering companies out of nowhere and just giving people free money to try to be entrepreneurs, that's not going to work either. But in any event, the more, when you look at the benefits of diversification, you get about 85% of them by the time you get to 25 companies, which is why most people land on that number, because it's diversified enough, but you still have time to be a lead investor, be present, be at the board, do good governance and all that other shit. So then you get into, do you believe in picking? And, do you believe in picking is a vexing question. And I think people think about it slightly the wrong way, because you're actually not trying to determine a winner. That's the wrong way to think about picking, because we cannot determine who's going to win. What we can do, though, is we can look at whether we're putting the right kind of risk, the right kind of risk-return trade-offs in the portfolio. This is where discipline comes in, which is, are we putting the type of return profile that we need to be putting in so that on a whatever level of diversification we've chosen, we've put enough shots on goal for things that are multiple fund returners. That's what you're trying to do. You're not trying to determine from the outset whether every one of your companies is going to win, right? We'd all be Warren Buffett if that was possible. There's a misconception there.
Yeah, no, but what you're saying is in other words, is what we're doing is can we as a team or as an investor see an outcome that is big enough for it to justify the level of risk that we know that is inherently here. So we can see this making enough money for it to grant whatever risk in our model exists with this investment.
Correct. And then the risk type you take is also important, because there are some risks you cannot mitigate. So for example, getting market timing seriously wrong as a seed fund is death. Because even if the company ends up doing great, if you have to carry it through multiple rounds before the market's ready, I mean, you can't recover from that. Very often you see portfolios go wrong where systematically they're at the mercy of a complex value chain or a regulatory environment that's very unpredictable. So back in the days of wireless semiconductors, when that was all the rage, a lot of companies ended up going bust because the dependencies on every actor in the value chain were so high that you weren't in control of your own destiny. And so when the market turned and giants emerged, etc., like these portfolios got cremated. And so that's a type of systemic risk you're putting in your portfolio that you don't quite see, or that you have to be cognizant of, because it's let's say that there is a diversification desire. There's also probably decorrelation, which is, are the assets in your portfolio correlated to each other? You might have a diversified portfolio, but if everything's in the same segment with the same kind of risk type, you've kind of loaded up the boat on the risk you're taking. So I think decorrelation is also quite attractive.
What do you, Fred, identify as, let's call it thesis-driven investor? Do you identify as that or not at all?
Whether we are a thesis-driven investor requires actually a complex answer. Because we're at seed, the more we focus on thematics, the more we tend to converge back to things that are obvious. So, if you're a Series B investor, you can absolutely be thematic, and you should. When you're at seed, we're unlikely to predict the future better than founders will. So founders typically are better than we are at identifying white spaces that we've never thought about. And so a little bit like Founders Fund in the US, we try to be like a blank slate and say, please come and surprise us with shit we've never thought about. And in fact, our job is to be mentally plastic so that we can look at either things we've never seen or things that have never worked in the past, but actually will work now. Because the other thing is like how you over-index on pattern recognition. You're like, wow, this got tried 5 times before. But then there is always a time and a reason why now is the right time for an idea that's not worked before. And so I think this is really where this beginner mindset comes in, which is I'm going to assume I know nothing and be curious and ask all the stupid questions and kind of think from first principles back up. And so in that sense, I think of myself certainly as anti-thematic, which is I'm open to anything as long as from a first principles basis, I can get my head around why it's attractive for the kind of deal that we try to do. Now, thematics are helpful because they could carry you for a year or two. You go deep into a sector, you develop a lot of expertise, and that can help. Remember, we're focused on London as our core hub. So we decided to go geo-focused. If you're going to be a global fintech investor and you're building the network and the expertise and the people, etc., I love that too as a strategy. I think it's not the one we pursued, but I think it's highly valid,
Just to shine a bit of limelight here on Stride specifically. So if you're anti-thesis driven, which I like, there's a fine line of also how do you communicate with your LPs, because the beauty of saying we invest in these sectors is that it's super easy to understand and it looks great in a deck and everyone knows what you're doing, and then you say, and we only do this, we don't do that. So it's very easy to understand, and the human being loves simplicity, right? When you say you're antithesis driven, you're kind of saying the opposite. You're saying, well, we're here to be wowed, so come wow me, right? But how do you balance also? Do you do like drug development deals? Is that something that you'd be willing to do? Like where do you define the limits?
So first of all, the hardest thing. So I like, again, let me back stuff that makes a ton of money, that scales at venture scale, and that has a positive impact on the world in some shape or form. But I like a bit like Founders Fund. I'm like, I will fund absolutely anything that I think has the kind of potential we're looking for. And it is the hardest part of my conversation with LPs, which is like, well, what are you about? Now, there is a bunch of things we don't do, because the other cardinal rule I have is don't invest in things you don't understand, which sounds counterintuitive, but I don't think it is. So we definitely don't touch biotech. Neither do we touch tech bio, because when you dig into tech bio, for me, everybody says, oh, they're AI computational platforms. But you know what? Before you know it, you're developing targets for specific conditions, and you're back in an FDA approval process, and it's like, oh shit, I kind of landed in biotech.
How did I get into
doing
this?
tech bio. The vast majority of projects. So don't touch that. We don't touch climate. We don't touch energy. We don't touch quantum. We actually exclude cybersecurity. We really don't touch analytics. So we have a lot of exclusion areas, either because we don't know anything, we don't know enough about them. Energy would be a good example, or because we think there's some form of uncapped upside. Like we look at 100 analytics companies a year. We almost never touch them because we think they're really difficult to scale to the kind of outcomes that we need. And on top of that, you're likely to get your ass handed to you by a West Coast company that's going to be or Israeli company that's going to absolutely kill you. So the tough, for me, a tough segment to invest in out of Europe. So everything we do is focused on humans. And so it's like, how do we reinvent or rethink the core services that we use as humans? So it could be work, play, finances, it's how we interact with each other at work, in our personal life. And so actually, if you think about it, we don't invest in everything. We're like, how do humans interact with their core services, mediated through technology? And software is a tool for generating new experiences effectively. This is where we drop back into design, the primacy of product, and so on and so forth. So when you boil it down between our geo-focus and the fact that we focus on humans, it's not like we invest in everything. Now, within that, I do articulate thesis to our LPs, because it's kind of how they think about the world, and they want to put you in a box. It is a little bit of a construct, if I'm completely honest, which is, it's not that like we're sort of retrofitting the portfolio to fit certain themes, future of work, blah, blah, blah. But, all VCs effectively say the same shit. And what passes for investment strategy very often for me is quite mundane, to say, we're investing in mental health. I'm like, okay, we invest in future of work. I'm like, what the fuck does that mean? So that's not an investment strategy for me. That's a high level thematic. And the more you try to go into defining precisely what's driving you, you can look at the big wave drivers, workflow automation augmented by AI. And you say, well, that's a thematic. Okay. So that gets a little bit more precise. But, this is where the founders surprise us, because they work in the liminal space between the themes. They come up with shit you've never thought of. And that's the joy of doing my work. And so in a way, I kind of refuse to be overly thematic, because I think we'd just be missing out.
Where do you stand on and I totally agree with what you're saying about the buckets. I think it's kind of a learning of mine. And I think there's this tendency to think of, as an LP, think of, this is my whatever geo bucket or whatever sector bucket, and then nothing adds up, right? I'm starting to see that playing out. I've done my first LP ticket 2 years ago. So we're starting to see, the underlying portfolio kind of building up, and it's like, it doesn't match anything I could have predicted. By the way, I could have kind of, I don't know, classified or categorized the GPs we backed. It's so random, right? And when you have wide portfolios, it just 10x's that randomness. but the question was a very different one. So you talked about human interactions, the way we work, the way we play, the way we interact with each other, the way we interact with businesses. Where do you stand on the B2B, B2C spectrum?
I would say B2C in general has suffered, in particular, from a degradation of channels to market that has been so marked and so brutal that, you know, your acquisition strategies have become way more complicated. And it is such an important part of building B2C companies that, you know, if you can't get CAC under control, if you can't scale into channels, etc., like, it's just exponentially hard. And I think a big reason why you see fewer companies getting funded is because that's the case. And so there are some decent product companies being built in anything from pet food to self-care. You know, most of them end up going through retail. Now, if you're building a hair loss product that's subscription-based for men, and your, you know, annual revenue per user is $200 and you're making 50% margin on your products, I mean, you can absolutely build a business on that. So you're still going to find segments where high subscription value, etc. Like, you can absolutely go DTC on that thing and nail it. But everything else, I think the channels have become hard. And so they're just unbelievably difficult to scale, especially because the only way to really reduce costs typically is to build brand. And to build brand, you have to go above the line. And say in the UK, if you wanted to build a national brand, it's probably £10 million a year to sustain, you know. And so that's like, that goes out the door first, because otherwise you can't get your CACs down. And so, you know, in capital constrained environments where paybacks are long, etc., that's sort of a tough game. So I think DTC suffers from that problem, or B2C in general. You know, it's very hard to generalize, because what my suspicion is, there's some great B2C businesses being built, and in 3 years' time, we're going to go, oh shit, look at that, look at that, look at that. Because whenever people think it's the end of history, founders surprise you with their ingenuity, you know, and what they come up with. So B2B SaaS, I think, is running into an interesting era, because AI changes the game in both good ways and bad ways. Where it gets tougher for startups is that the internal adoption of AI tools is orders of magnitude easier than anything else we've ever seen. So whether you're an enterprise and you want to deploy AI internally in no-code environments or with custom workflows, or whether you're an incumbent and you're implementing a Copilot or whatever it may be, you know, you're seeing the response rates of people to adopting AI to be much faster than anything else we've seen. So in the past, you would have these DNA evolutionary curves, which is, oh, we're on a new platform, it's called mobile. Or in security, it was the case, right? Every 2 years, you get a new security company that's on the latest kind of evolutionary curve. Now it's different, because the coding environments are pretty stable. We haven't had new languages come in. We don't really have new platforms that have come in. I mean, all the stack, everybody's on the same freaking stack. You know, it's like everybody's on Node and React, and, you know, so JavaScript is one, and C# and Python. And, you know, that's been very stable for a while, which means now we have, for the first time, this stable stack, better APIs, no code environments. And so I think that changes the game for a number of B2B SaaS companies. And one of my concerns is we are seeing a lot of what I would call marginal innovation or incremental innovation companies come through. And, you know, how many AI-powered sales automation businesses do we need to see? And, you know, or people go into a specific vertical and they say, well, hang on a minute, we're building a knowledge graph. You know, so it's not just an LLM layer or a Copilot. We have our own knowledge graph, but, you know, it may not be that powerful. And so it's concerning, I think. And I think there's a real question of how many super high upside pure SaaS companies we can still generate, because we are running a little bit out of road. Now, industrialization of overlooked segments, quote unquote, boring industries, I think there's a lot to do. I think industrial environments, there's a lot to do. Sensors, real-time sensing, predictive failure, like all that stuff, you know, optimization. So I've no doubt that there's a lot of opportunities left, but I do think that your mainstream SaaS investing, for me at least, I see fewer and fewer transformational ideas. And then I see the incumbents, if you look at Intercom or Gong or people like that. I mean, Intercom was fast in terms of adopting AI. You know, within weeks, the CEO had put 3 squads on it. Within 3 months, they had an internal tool working. Within 6 months, they were live in market with a fully fledged commercial rollout of their tool, which is called Fin. And, I mean, that's wow, for a large company like that, from start to finish, to be out with a fully functioning GA product in 6 months on a new technology. It's like, gee. So I think the game is changing there. And I'm a little bit scratching my head sometimes as to exactly where the angles are. So if you look at what we've done in AI, there are people who are quite orthogonal or doing fundamentally hard things. So we backed a company that's trying to mix a knowledge graph with reinforcement learning, with LLMs, and the way, which effectively is a way to construct complex long-range strategies. I mean, that's like generally hard from an engineering standpoint, and there's something quite unique about it. And I think that has there's a substrate there to do something special. But if you don't see that, I'm a little bit nervous about this. Again, these obvious themes that we're just all pursuing the same shit. And then you're going to have 10 venture-backed companies fighting each other on how good they are at sales,
So Fred, we're almost out of time, and I want to bring us back to where we started, which is where's the market at today, and wrap up with asking you probably the funny question or interesting question of what are, given the way things are today, what are you excited about? What do you find yourself getting excited about when you think about the coming months or years?
At the moment, I have to be honest that I'm very much in a kind of pendulum between excitement and concern. And it is difficult for me to look at the state of the world in general, between erosion of democracy, mental health crisis, climate, Ukraine and Israel, and to not take some form of pause and to say, like, where the fuck are we going as a species? And of course, progress has helped us get out of poverty, etc. But I think, I heard someone the other day describe humans as, we're behaving like parasites at the scale of our planet. And I think there's something to that. So I would say that at the moment, I'm trying to sit with that and think about what is our impact and our responsibility. And what I'm excited about is I think there is an increased level of realization that we need to reintroduce humans at the center of what we do, community, connection, relating, and that what started as a little trickle is starting to be more of a movement. And I think it's showing up in a bunch of places. It's like there's whilst at the same time we see this polarization around the Israel-Palestine conflict, but I'm also seeing an undercurrent of people realizing the power of community, learning from the elders, just kind of understanding the natural cycles of the earth, etc. And so I see this kind of, I can't say I'm extremely positive right now, but I also see this change in kind of awareness and consciousness. And I see it a lot in the founders that we back, which is, there's such a trope now. You see somebody out of the West Coast and they're like, we are on a mission to improve the world. And half the time it's complete bullshit, right? It's just something they say. But now I'm seeing this very much in the younger generation, like it's quite deep in their system that they are thinking of their responsibility, their role, their impact at quite a deeper level than my generation did. My generation was the fucking 90s and American Psycho, right? I grew up on American Psycho style environments where it was all about the money and finance and consulting and all that crap. And so that I'm quite excited about, to see this, I think, just increased level of awareness of where we're at as a species, what we're doing to each other and to our planet, and kind of what we should do about it. So it feels a bit like a tipping point there. I'm kind of somewhat hopeful that takes more amplitude.
So I'm going to ask a follow-up question to that, and it's a bit personal, so we can cut this. Are you religious, Fred? And when you're talking about that, how does that come into play? And you might have a religion, you might be agnostic in the sense that you recognize a deity, or atheist where you don't really believe in anything besides the human being.
So to your question as to whether I'm religious, I'll start by saying that I am concerned about religions, particularly in the environment we're in, as a tool of power, influence, and politics. I think that if religion is a way to the spiritual and asking ourselves the great questions, of our existence, it's a beautiful thing. And, there is whether you look at the Catholic tradition with the Gnostics and the great thinkers, all the way to the East is the most obvious example. All religions have deep, beautiful thinkers that consider the human experience in a way that's quite profound. Religion today is the big challenge of our age, right? We probably have 150 million radicalized, individuals on the planet who are intent on destroying another 10 million. I mean, this is kind of a big geopolitical problem that I don't think is particularly helpful right now. So my personal view is I'm deeply interested in the nature of the human experience and the sort of profound mystery of the human experience and the transcendence sometimes of our own death, right? Which is fundamentally what this is all about, which is, what is this weird construct where we're thinking bipeds go from birth to death, and death is the only known certainty. And, through that, we go through pain and heartache and growth and joy and all that stuff. And what is the transcendence in that experience, right? And that I find fascinating, whether you explore it through religion or through mysticism or through meditation. I'm game. I think that is what unites us, is the kind of wondering about the beauty and heartache of what it means to be human.
I am David, the LP Syndicate Lead. Thank you so much for tuning in today, and can't wait to see you all out there.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.